Hey everyone, welcome back to Corporate to Coast, where we break down boring corporate filings into juicy insights. And let me tell you, Monogram Technology's latest report is a mixed bag of exciting news and potential red flags. Just brace yourselves. Alright, buckle up folks, because we're diving into Monogram Technology's financial report for the quarter ending June 30th, 2025. This report is super interesting because it covers a period right before some major events that could really change the company's future. This whole filing is dominated by one big story, the pending merger with Zimmer Biomet. If you haven't heard, Monogram is being bought by Zimmer Biomet. This is huge news for a company that's been burning through cash and trying to get its innovative robotic surgery tech off the ground. Let's look at the numbers. On the balance sheet for June 2025, Monogram had about $12.8 million in cash. This might sound like a lot, but remember they've been losing money. Their total assets were around $15 million, while their liabilities were about $6.4 million. What's interesting is their total stockholders' equity was only $8.6 million. This shows they've got liabilities that are pretty significant compared to their overall value. Now for the part that gives us a real picture of how they're doing, the income statement. For the 3 months ending June 2025, Monogram lost $5.4 million. And for the 6 months of the year, that loss jumped to $8.6 million. This is a pretty big loss for a company that isn't generating any product revenue yet. In fact, the report clearly states they had no product revenue in these periods. A big chunk of their expenses, as you'd expect for a tech company, is research and development. They spent about $4.5 million on R&D in the first 6 months of 2025. This is slightly less than the same period in the previous year, which makes sense because they were finishing up getting their robotic system approved by the FDA. General and administrative costs, which cover things like management salaries and office expenses, also went down. They spent about $1.8 million in the most recent quarter, compared to $1.1 million in the prior year quarter. The report mentions some of this decrease was due to employee retention credits, which is a nice little boost. But here's where things get a bit unusual. There's a significant other expense of $2.5 million in the second quarter of 2025. This is tied to a termination agreement with Mount Sinai, a medical research institution they had a license agreement with. It seems they had to pay a hefty sum to end that deal, which really drove up their losses for the quarter. When you look at the bottom line, the net loss for common shareholders was $5.6 million for the quarter and over $9 million for the 6-month period. This means that even after accounting for preferred stock dividends, the losses are piling up. Looking at the stock section, they had about 4.2 million shares of Series D, preferred stock outstanding at the start of 2025. However, a key event happened. On July 7th, most of this preferred stock was converted into common stock. This often happens when certain conditions are met, like the stock price hitting a certain level. As of July 14th, the report says there are no more Series D preferred shares outstanding. This is quite a transformation for their capital structure. The company also grants stock options to its employees. As of June 2025, there are over 5.6 million options outstanding. These options are essentially the right to buy company stock at a set price in the future. The key here is that for the 6 months ended June 2025, they had over 15 million potential new shares from options and warrants that were anti-dilutive. This means if all of these were exercised, the value of existing common stock could be spread out over many more shares. Avrano, if in nat for the 6 months ended June 2025, they had over 15 million potential new shares from options and warrants that were anti-dilutive. This means if all the 25, they had over 15 million potential new shares from options and warrants that were anti-dilutive. This means if all of these were exercised, the value of existing common stock could be spread out over many more shares. Remember that Mount Sinai deal we talked about? On July 9th, they finalized the termination. They paid $500,000 in cash and issued 35,000 shares of Series E preferred stock, valued at $3.5 million to settle the agreement. This Series E stock is a bit unusual as it ranks higher than Series D and is redeemable. It's a significant chunk of preferred stock being issued. And as we mentioned, the big news in July was the mandatory conversion of their Series D preferred stock. After hitting specific stock price targets for 10 days straight, all those preferred shares automatically turned into common stock. This is a big deal because it simplifies their capital structure and potentially paves the way for the merger. The biggest event, however, is the merger agreement signed on July 11th with Zimmer Biomet. This deal will see Monogram become a wholly owned subsidiary of Zimmer Biomet. For Monogram's common stockholders, this means getting 4 share in Series $1 in cash per share, plus something called a contingent value right, or CVR. For preferred stockholders, it's a cash payout as well, $2.255 in cash per share, plus something called a contingent value right, or CVR. For preferred stockholders, it's a cash payout as well, $2.25 a contingent value right, or CVR. For preferred stockholders, it's a cash payout as well, $2.25. For CVR, plus something called a contingent value right, or CVR. For preferred stockholders, it's a cash payout as well, $2.25 for Series L, $2 for $2.25 for Series E. The CVR is basically a promise of future payments if certain performance milestones are met. This acquisition signals a potential exit for investors and marks a significant turn for Monogram's technology. It's also important to note their at-the-market common stock offering. Through June 2025, they had sold over 2.4 million shares, raising about $6.2 million. This type of offering allows companies to gradually sell shares into the open market, often to fund operations or development. Back in July 2023, they also had a purchase agreement with B. Riley Principal Capital II LLC, allowing them to sell up to $20 million in stock. By June 2025, they had only sold about $1 million worth of shares under this, so it looks like they didn't rely heavily on this particular funding avenue before the merger announcement. Monogram is definitely in a funding required situation. They've openly stated their ability to continue as a going concern depends on their ability to raise capital. They believe their current cash, plus funds from their purchase agreements, will keep them afloat. However, they are also very clear that if the merger doesn't happen, they might need to tap into other financing options, like a loan agreement for up to $15 million. Now let's talk risks. The most glaring risk is that the Zimmer Biomet merger might not go through. The report lists several conditions that need to be met, like getting stockholder approval and regulatory clearance. If this deal falls apart, the company's stock price could tank because the current price likely reflects the expected merger. Plus, they've already spent money on this deal and could face termination fees if it doesn't close. Also, the uncertainty of the merger could make it tough to keep employees and partners happy. It's also worth noting that certain executives have entered into voting agreements with Zimmer Biomet. This basically means they've agreed to vote their shares in favor of the merger. This helps ensure that the necessary approvals are secured. The good news on the risk front is that the report states there are no defaults on senior securities, which is always a positive sign. In terms of legal matters, a lawsuit filed by a former investor back in July 2023 was successfully dismissed in June 2025. This is a positive resolution for the company. Scroll now, let's wrap this up with my take. Monogram Technologies is in a really interesting spot. On one hand, they've developed some pretty advanced robotic surgery technology and managed to get FDA clearance for their TKA system. That's a huge technical and regulatory achievement. The impending acquisition by Zimmer Biomet is a major validation and provides a significant financial exit for early investors and employees. The conversion of preferred stock to common stock also cleans up their balance sheet nicely. However, we can't ignore the red flags. The company has been consistently losing money, and their cash burn rate is substantial. The reliance on external funding, like the purchase agreements with B. Riley, was obviously a temporary solution, and their future as an independent entity was always going to hinge on securing more capital or getting acquired. The other expense related to the Mount Sinai settlement is also a harsh reminder of the costs involved in navigating IP and business relationships. The biggest unknown right now is the merger. If it goes through, Monogram's technology will likely get a massive boost from Zimmer Biomet's resources and market reach. If it doesn't, they'll be back to square one, needing to raise significant capital to continue chasing their vision, which could be a tough road given their current financial state. In essence, Monogram is betting the farm on this merger. It's a high-stakes game, but the technological innovation is real. We'll be watching closely to see if this deal closes and what that means for the future of surgical robotics. Alright, that's our deep dive into Monogram Technologies' latest report. What are your thoughts on this potential acquisition and the company's financial health leading up to it? Let us know in the comments below. If you found this breakdown useful, give us a thumbs up and subscribe for more corporate insights. And don't forget to join our Discord community linked in the description for even more discussions. Thanks for watching, and we'll see you on the next episode of Corporate Decode.